Hello and welcome back. I am your host Kyle. Today's date is August 7th, 2024. As inflation starts to really cool down and potentially we start talking about the Federal Reserve lowering interest rates, I think it's about time that we talk about the topic of possibly changing where some of your free cash is hanging out and what it's doing, what it's working for you. So, of course, there's high yield savings accounts, right? Very popular, but really only are going to be to your benefit while interest rates are high. And while those don't have necessarily a direct correlation with the net return on your high yield interest savings accounts, they definitely do have an impact. So that's a great option that's out there while interest rates are high. But as inflation starts to cool down, and potentially maybe not in September, but possibly if interest rates do start to come down, you will probably see that in the yield that your banks are offering through your high yield savings accounts. So there's a few options out there, and I wanted to run through a few of them. Number one being CDs, specifically through possibly even the bank that you're already using. CDs have specific terms ranging from a few months to several years, of course. And what you're doing is you're essentially promising to keep your money in that account, in this container of funds for X amount of time, be it 6 months, 9 months, a year, 5 years, whatnot. Typically, they offer a little bit higher interest rate than savings accounts because your money is locked in for a set amount of time, and then the bank knows there's an expectation that they'll be able to use those funds and have them available for themselves and their own investments for that set amount of time. Now, not always are they offering a higher yield interest rate than current other savings accounts, or maybe even other CD products at shorter terms. That all varies based on kind of what the bank is expecting interest rates to do in the following years to come. Now, they are safe. They are still considered a safe investment as they're almost always FDIC insured, and so you can have up to $250,000 locked into one. Sometimes there is early withdrawal penalties, so that is something to keep in mind. Unlike a high yield interest savings account where you can just kind of move that money around freely as you want to or as you need to, you will potentially be dinged and lose out on some of your gained interest, if not all of it, by simply withdrawing before the end of the term. Now, the other catch is the renewal. So many CDs automatically renew at maturity unless you intervene. So you do have to be aware of when that renewal date is coming up, especially if you originally purchased one that is multiple years out. You're going to want to make sure that you don't miss that, because you're probably only going to have a couple weeks to a month, give or take, window to actually get out of it by the expiration. And if you don't, then you're going to be rolled right back into another one. Now, there is some strategies. Specifically, one is called the laddering strategy, and you can invest in multiple CDs of varying expirations and variable interest rates to both kind of give yourself liquidity as time goes on. That way you have funds kind of rotating in, rotating out, and as well as being able to take advantage of some higher interest rates, maybe in some smaller margins, while also maintaining some of that flexibility. Now, CDs, even high yield interest savings accounts, they really aren't doing a world of wonder unless you have a decent little chunk of change in there. If you're just throwing in a couple $100, it's probably not going to do all that much for you, not going to make a significant impact. But the options are out there, and if you are not familiar with them, they're certainly worth exploring and getting to know. Absolutely. So next you have dividend stocks, of course, which is something probably all of us have at least heard about now or are aware of. Dividends are typically paid out quarterly. Some pay out monthly, some semi-annually or annually. They can be issued as cash or by additional shares of stock. The dividend yield shows how much a stock is going to be paying out on your basis amount over the following year. It's always calculated out annually. The dividend yield is not how much is going to be paid to you on the next dividend payment. So if it's a 10% annual dividend, which is really high, then your quarterly, let's assume that they pay out quarterly, your quarterly dividend would be about 2.5%. Now, there are different types of dividends that you can go for. There's the big blue chip stocks like Amazon and Apple and Microsoft and whatnot. And alternatively, you could be targeting companies that have been paying dividends for well over 25 years, maybe aren't as big as some of those blue chip stocks, but do consistently have growth within their dividend payments. And there's a lot of value in that as well. Not just receiving dividend, but that the dividend over time is growing in its return rate. And then you also have high yield stocks. And I've talked before about certain products like Yield Max, where it's a little bit more risky, possibly even significantly more risky, but your return, your annual return, could be upwards of 12, 15, maybe even 20% if the conditions are right for it. So a higher risk, a higher return. Now, most investors do a dividend reinvestment program. Acronym is DRIP, DRIP, to automatically reinvest their dividends into more shares of the company. Alternatively, you would just be paid out in cash to your account, and then you would go and have to manually reinvest that, or maybe you have another company that you want to turn your money into for dividends. So dividends are another great way to take some of that spare cash on the side, especially as interest rates are coming down and you're not going to be able to maximize out of high yield savings accounts some of those more safer investments so easily. Hopefully you can find some dividend stocks, and we'll talk about these more in other videos. Absolutely, I'm a big dividend guy. So hopefully you can find some that both kind of meet your risk appetite, but also generate some good healthy returns to you going forward. Then you can do some other things such as selling covered calls, which is an options play. And I'm not sure I would necessarily quite recommend that. You're selling contracts against shares that you own to somebody else for the right for them to be able to buy those shares off of you at a set price before a certain expiration date. So you can harvest some premium is what you would be collecting in that scenario. And that's a whole nother video in itself as well. So covered calls is of course another one. I would not do naked cover call selling. Peer-to-peer lending is another one. If you've heard of platforms like Lending Club or Prosper, and there are probably a few others out there by now, they allow you to lend money directly to other people, other individuals or small businesses for interest payments. And they're paying back the basis as well, but you're collecting possibly 7, 8, 9% interest, and if not more, based on kind of current lending rates. And then the companies that act as a middleman are taking a little bit of that too. So they're providing you a platform to be able to lend directly to other people. They take a little bit out of the middle, out of the process, probably a few percentage points, and you're getting exposure to not only a higher yield, but again, possibly higher risk, because there's not much guarantee, especially peer-to-peer lending, that the opposite party is going to actually fulfill their debt obligations. So just a few different ways, I think 4 different ways that we went over there that you can consider looking into now that high yield interest savings accounts might not be performing so great in the near future. But it really just kind of depends on what you're looking for, how much money you have available to you, how much risk you're willing to take on, and how liquid you need that money to be. Now, of course, if this is like your emergency savings or something like that, I wouldn't be doing any of those with my emergency savings. My emergency savings is sitting in savings accounts, high yield saving, and a little bit not in high yield in a physical bank close by near to me, so that if I absolutely need funds very quickly, I can either get them same day or I can have them transferred to my account within 24 or 48 hours. So this is all on top of if you already have your emergency savings accounts set up, which absolutely definitely do that. So What we're looking forward to tomorrow, we have some jobless claims data, and the Fed's balance sheet numbers will be coming out as well. And we are also getting updates for mortgage rates, which seem to be coming down just a smidge. The Fed's balance sheet has been doing pretty well in letting go of assets that they've been holding on to from a COVID high of $8.97 trillion worth of assets and inventory. They are now down to 7.18 trillion, almost a 20% decrease from that all-time high. And they are continuing to let go of about $25 to $40 billion in assets a week. So I am liking the progress that has been going on there. Next Wednesday, we get some new inflation data. I can't wait to see those numbers. And hopefully then we have a little bit better idea of what the Fed might be considering for their September meeting if the numbers come in really good. So thank you so much for watching. Please consider liking and subscribing. Your support means so much to me, and I will see you all after market close tomorrow.